Good afternoon, everyone. Everybody take a seat. We're going to go in and get started here. I want to welcome everyone here today, all of our guests, to our annual Colliers Houston Trends event. I'm Bob Parsley, Chairman of Colliers here in Houston, and on behalf of all of our many professionals and staff, we want to thank you for joining us for what we consider one of the highlight events of our calendar year. We've been holding this event for 20 years, and we always look forward to providing you a snapshot of the Houston real estate market as presented this year by the president of Colliers Houston, Pat Duffy, along with having a well-known national speaker discuss some pertinent issue of the world today. We've been honored to have some of the leaders in industry and in the world of economics speak here at Trends. Speakers like Larry Kellner, President of Continental Airlines, Don Canals, President of Coca-Cola USA and CEO and Chairman of Clorox, and Tyler Matheson with CNBC News and the anchor of CNBC's highly rated Power Lunch, just to name a few. Tonight, we're excited to invite to the podium for the second time Mr. Casey Conway, principal and co-founder of the Red Shoe Economics team. Before we begin our presentation, I'd like to personally thank all of the Colliers charity partners who participate in both our Trends event and our Colliers charity golf tournament. Our major underwriters include Able Design Group, Agile Interiors, Allegiance Bank, Architectural Floors, Bird Interior Construction, Granite Properties, IAG Business Technology, Lane Property Tax Advisors, Title Houston Holdings, and Wilson Cribbs and Gorin. In addition to our major underwriters, the list of our sponsors is found in the inside cover of your program. On behalf of all of us here today, I want to give thanks to all of our major underwriters and sponsors for their support in partnering with us to benefit our community and making these events possible. Give them a hand. Every year we select a Colliers charity beneficiary that is the recipient of the funds that we raise through our charity partners. This organization is selected by a committee of Colliers professionals and is typically a Houston-based organization that is making a difference in our community. Not always the biggest organization, but an organization that is making an important impact on our community. Our charity partners also participate in the annual Colliers Charity Golf Tournament, which this year is scheduled for April 28th. Now I would like to introduce you to our 2022 Colliers Charity Beneficiary, Rescue Houston, represented by its founder and president, Mrs. Allison Meyer Madrigal, who will speak briefly about Rescue Houston and its impact on our community. Allison?
Thank you, everyone, for choosing us as the charity. We are going to start with a small video that's going to give you a glimpse of trafficking in our country. So this is the reality that not only Houston is facing, but our country. Trafficking in America looks completely different than it does in a third world country. As you can see, let's see, hold on, I think I got to flip through. Many people are surprised that over the 600 victims that we've rescued since 2014, 95% of them are domestic U.S. citizens. And so young girls are being trafficked from high schools right in Houston, Memorial City, Katy High School. The way the traffickers and pimps are grooming them is they're finding them online, or they're sending groomers into schools, even church camps, to befriend the boys and girls and lure them into a new friend group, convincing them to run away from home or to perform sexual acts. And this is how trafficking happens in America. So we did a case study in Houston. We pulled data from 2 websites that sell sex online, where many of those are victims of trafficking. You will see all the green dots in Houston are actually massage parlors that actually advertise sex online. We've got strip clubs, sex shops, and individual escort ads. Now, many people think strip clubs, women choose it. The reality is the majority don't, and they have a story behind them. And so these are the places where trafficking is actually happening in the city of Houston. So the survivor realities. This was a study done in 9 different countries with prostitutes and trafficking victims. 89% said, hey, I want out of this lifestyle, but felt like they didn't have any options. Then when we look at the other statistics, it shows us what kind of programming we have to have to heal these victims. 68% have PTSD, the level of combat vets. 62% were victims of child sex trafficking, and another 62% were actually romantically involved with their trafficker or pimp. So our mission at Rescue America and how we're responding is we are a 24/7 rescue hotline. We exist to rescue, revive, and empower the sexually exploited through our 24/7 hotline and emergency response. So we began in 2014 in Houston, and we have had over 2,400 hotline calls. Of those calls coming in, over 1,600 have actually been victims of trafficking, and we've actually rescued over 600 exits. We got our grounding, we started in Houston, and in 2019, we just started getting calls across the country without marketing our hotline number. And this shows the transient population of this population where they go from city to city. So we'll end with some survivor quotes that are the most important and the impact the organization has had on them. One of our clients said, it was a blessing to be in their arms because they were in my corner every second of the time that I was there, from the time that they answered the phone to the time that they connected me with my program. Another one said, I feel like Rescue America is one of the best places to call when you're in danger because they have quick responses and will be there in a matter of no time. And another one said, I haven't felt this cared for in years. You guys are truly saving lives. Thank you so much for all of this care. So we want to, if you guys feel pulled to this cause and you want to learn more, you can subscribe for some information to learn more about trafficking and how you can get involved. But we're just grateful to be the chosen charity for Colliers, and we look forward to the rest of the evening. Myself and Adrian will be here mingling if you want to connect with us. So thank you so much.
Bob brought this up, but one of the best things I think Colliers does is focus on what can help this community. So we always do pick a charity. We love this one. We had a little false start last year because of a virus that's going around. We're very happy that we were able to have them here live this year. We've got lots of good news this year. It's actually, last year was sort of, we weren't sure what was going on and it wasn't good, what little we knew. This year it's almost all good. Main thing I think you want to take away from this slide is you can see during COVID we lost 200,000 jobs. We've gotten most of those back in 21, and the prediction coming out of the Greater Houston Partnership is that we will have about 20,000 more jobs by the end of this year than we had at the end of 2019, which is not the case for the rest of the country, by the way. So we're one of the few cities that's more or less fully recovered. The really good news for Houston is in the last year, the long graph you see there, mining and logging, that's the energy sector. And after losing an enormous number of jobs, they had a 17% growth in jobs in 2021. The only sector that downsized a little was government. Whoop! Not enough, but we're working on it. Sorry, government people, I'm sorry. Single-family housing, I think everybody is aware, is on fire. We have one of the lowest inventories in the country in the history of tracking this data. Houston saw a very large 16% increase in average home price. For a little bit of background, the average over eternity in Houston has been about 3%. And the reason we've never had big spikes is because we can deliver product faster than the rest of the country. So we normally don't get the bubbles that most of the other markets get. But the 16% increase is to a large degree because everybody wants to move here. And KC's going to go deeper into this, but Texas moved back into the #1 spot for where U-Hauls are ending up. The #1 exit for U-Haul is California, but the statistic is broken because, and I'm not making this up, U-Haul ran out of units to rent in California. So you have to go over to Penske, and for $5,000 you can rent a truck for 3 days to leave California. So with our population growth, Houston, Dallas, Austin, obviously, the whole state is winning. That's bolstering the single-family market. Retail, wouldn't have guessed this one, frankly. We had 3.1 million square feet of net absorption in retail last year. That's very strong. The vacancy rate's only 5.8%. We absorbed 3.1 million feet. We only have 1.8 under construction, and most of that's 50% pre-leased. So the retail market is very strong. We're fighting over spaces, more in the restaurant space than traditional hard goods retail, but all of it's working. The two big projects that are underway right now, big being a relative term, normally we would see 300,000, 400,000, 500,000 square foot power centers being built. Right now the largest is a 199,000 square foot center. That's anchored by a super target. There's only 55,000 feet of other retail in that center. Doesn't move the needle, and that's about 50% pre-leased. The other big project is a 300,000 square foot Fort Bend Town Center 2, which is anchored by Cinemark. They've got 200,000 square feet of non-Cinemark, non-restaurant space, and according to their marketing, they're 50% pre-leased. So those are the two big projects, and they're leasing up about as fast as we can build it. Cap rates, and this is on the investment side, we generally run higher by 50 to 100 basis points than the rest of the country in terms of average cap rates. The reason for that is there's almost no barrier to entry in Houston. So if we run out of retail space, we just build more. If we run out of houses, we just build more. In San Francisco, try to build anything. So their cap rates tend to be lower because there's a supply side constraint. But the market's very healthy. If you had told me 10 years ago that we'd be talking about cap rates in the 6s, I'd have laughed at you. I still chuckle occasionally, but that's when we're on the selling side of the deal. Multifamily, I think everybody is aware multifamily is going crazy. We had a great year. We absorbed 37,000 units. We only built 21,000. So the occupancy is back over 90%. Market's gotten very healthy. The average increase in rents in multifamily for the last year was 18%. And so when we look at the cap rates in here, and again, we got 21,000 were delivered. There's 30,000 proposed, which is fairly normal for us. They don't all get built, and it takes a couple years to do it. But if we're absorbing, and 30,000 net units was up from 17,000 in 2020, but If we're absorbing 20 to 25,000, this market's pretty healthy, but we're going to talk about where it is in terms of the cycle. But you can see in this one, cap rates in Houston are barely above the national average. We're showing 5.4. We're hearing about cap rates on some deals, if they're the right fit, that are in the threes. It's just insane, not necessarily in Houston, but out in California in particular. And that's the bet that rents are going to be going up. We can't supply housing fast enough, certainly not right now with the supply chain. So apartments, you got to live somewhere, right? Or the rental housing, that's the new, we talked about that about 2 years ago, for rent communities that are being built. And that's a good way to get around municipalities that don't like vertical apartment complexes, so you build a horizontal rental housing. So that market's very healthy. The office market, we should skip. This is the one downer. I'm sorry if you're heavy in office. But so the vacancy rate is still 25%. It's moved up 100 basis points. The one that really caught my eye this time was that post-2005 vacancy. Last year was 11%, and now it's 18.6. No big shocker here. Work from home, COVID, there's all kinds of things that are impacting the office market. I can tell you anecdotally, the volume of activity for office leasing is way up. People are coming back to work. I'm going to let KC touch on some more of that here in a minute. At the end of the quarter, last year was dismal. We lost 1.9 million square feet of occupancy. And we've got 2.9 million feet under construction, 55% pre-leased. Please don't build any more office buildings. Rental rates are down. This market's a little tough, but again, it's getting better, and we certainly are seeing the winners and losers. Flight to quality still exists, but there's been a lot of shuffling going on, especially within the energy companies, and they do move the needle. To get this fixed, we need the energy companies back in heavy hiring mode. There really is not. Well, we can more tech. Once Austin, you know, if you have a tick on a dog long enough, eventually it breaks. So when that happens in Austin, all that's coming over here. We actually have more tech jobs in Houston than they do in Austin, but they're just cooler than we are, I guess. So office investment market, it's been it's catch as catch can, and this one I'm not a big fan of cap rates when it comes to the market that's as sloppy as this one. Is that on actual occupancy, and it's 70% occupied, and there's a lot of upside. So the Class A market is still where everybody wants to own. They're going to have the best occupancy, and they're going to have the lowest cap rates. Industrial, carrying the world these days. There are two markets that are above 8% vacancy, Southeast and Southwest. Why? Because that's where we're building most of the product. So that has to do with us just delivering a lot of product. The post-2005 construction here is at 9.5. Last year it was at 15. So we absorbed a lot of the new construction. In terms of where are we in pricing, vacancy's down to 7.1%, which is pretty healthy. We used to run around 6 in industrial, but we can barely deliver it fast enough. We absorbed 28 million square feet last year. That's up from a normal of 15 to 17 million, so almost double normal. Being driven by Amazon and all the big players, but we've definitely become a distribution market. This is a fun one, and we talked about it last year. Last year we said the industrial market was on its heels because the only thing getting done, 76% of the absorption in 2020 was in 100,000 square foot and up deals. This year it was only 47%, but we did more of them. So the market absorbed almost double the square footage, but the big recovery occurred outside of the giant boxes, which is great news. Little bit of a plug, there were 72 leases, industrial leases done in Houston last year, over 100,000 square feet. We were involved in 34 of them, which is 48% for those of you that like to do math. I'm pretty happy about that. So our industrial team just crushed it last year. Cap rates, everybody loves industrial. I think they're about as low as they can get, which is why Houston and the country are fairly aligned. In this case, 6%, 5.6. Again, are there examples of cap rates below 5% in industrial? Yes, especially if the tenant is Amazon and they've got a long enough term. They've started buying because they've figured out that their property is worth too much money. So Amazon's shifting from being a tenant to being an owner. They got plenty of cash. That'll change the market a little, but not much. Healthcare, if you can't build office space that's traditional office space, build medical office space. So we absorbed 1.2 million square feet. The vacancy went up a little, so we were a little over our skis. There's about 2 million under construction. Little concerned about this one that we might be getting ahead of ourselves a bit. But if you're in the business of building office buildings and traditional's not working, you shift over to medical. A lot of growth in terms of population that drives the need for doc in the box. The more people you have, the more doctors you need, the more vets you need, the more dentists you need. So this market, as long as the population continues, is going to be fine. We could get a little over our skis, but these are small needle movers. This is debt delinquencies by product type, and we sort of lost the product type. The big spike is hotels. The rest of this is some senior housing, and office would be the second one. We lost our little thing. But so where are we in the market? This is what we said last year, and you can see the red dot down in the corner and the green one. Those were both in, we called it recession last year. Green was industrial. Needless to say, we've moved industrial way up to the top. We do think it's just past the center line in potential oversupply, just because we're growing so much, but it moved from the lower right-hand corner to almost back to balanced. Healthcare, you can see we had that in expansion phase. We've moved that more up to the top, where we're getting a little long in the tooth, and we may overbuild that market a bit. Multifamily, we had in a slight oversupply, or about partway down, and now we've moved that back to expansion, because we absorbed so much more than we historically do. So you think of a cycle as following a path. We just skipped the recovery phase and moved it back to expansion. And actually, they never even went into recession. So this is about whether rents are going to be going up or going down. Office, you see in the lower right-hand corner, and we think it's just more maturely in that lower right-hand corner, hopefully moving over to recovery soon. Retail, you see we have right up at the top last year, and now we've got it firmly over in the expansion phase. Retail's doing great, and we see the online people moving their stuff into bricks and mortar, so it's creating new sources of demand. And that's the end of mine. We are going to be streaming this. Do you want to do questions or no? Questions while we tee this up? Yes, sir. Pat? So Pat's question is, when do interest rates get so high that it starts a downward shift? I'm actually going to let the guy in the red jacket do that one, because I went to LSU. So in January of 2020, one of the comments that I made was that the market was going to be great as long as there wasn't a black swan event. And I mentioned that there was a virus in China that we were keeping our eyes on. I hate to admit this. Well, the next year I told you I was delivering this with COVID. That was a lot of fun. But the gentleman I'm about to introduce is the guy that told me about COVID about 2 months before I told you guys. I don't know if you had heard anything about it. But Casey Conway is probably the smartest real estate person I've ever met. Among other things, he was the commercial real estate advisor to Ben Bernanke at the Fed. When he left that gig, I think out of frustration, he's not a huge fan of the Fed, he went to work as the global chief economist for Colliers International, which is how I was lucky enough to meet him. When he got smart enough to leave us, he went to Sunbank, where if you wanted to borrow, I think, more than $10 million from Sunbank, he had to sign off on it. And then he went to the University of Alabama. Sorry. My inner tiger has a hard time with that one. But and he headed up a real estate consulting group out of the University of Alabama, where he dubbed himself the Red Shoe Economist. He now has his own company where he is doing advisory work, and it's the Red Shoe Economics Group, I believe. But when KC talks, you should listen. He bought Bitcoin when it was like $1 and then sold it when it was enough to put his kids through college. I'd never heard of cryptocurrency. This guy is way ahead of anybody I've ever talked to. So he's got a lot of thoughts today. I don't want to cut any more of his time. So ladies and gentlemen, Casey Conway.
Everybody hear me good? I don't have the big Donald Trump voice, so I'm not always booming. Anybody not hear me, or if I go low, do like that. So the first thing for Pat's comments, you make a great shadow economist, and I would say after your remarks, just a good amen on everything you covered. And to summarize it, how many of you do property types other than industrial? Okay, other than industrial or warehouse? No, you don't. So going forward, everything is a warehouse. If it's multifamily, you're warehousing people, residents. If it's healthcare, you're warehousing sick people. If it's office, you're warehousing office work. So if you put everything as an office or a warehouse category, you'll get a lower cap rate, more absorption, and funding, right? So everything is a warehouse for this year. So I appreciate the opportunity to be back and be here with you. So this is my cover slide. How many of you have had Chinese food or been out to a Chinese restaurant so far this year? Awesome. So some of you know, and it was today is the new year starts, and it's the year of the water tiger, and that is the year of extremes. Now I'm telling you, I'm scared to death of this damn tiger because it's in 12-year cycles. So let's go back. I was born in '62. I'm a tiger. I'm extreme, all right? All right. So let's go to '74. What happened in '74? We had Watergate. We had the start of the whole S&L crisis, inflation, all that kind of stuff started. Go from '74 to '86. How many remember the change in the tax law that triggered the S&L crisis and blew up the whole world and everything, right, including energy? Go from '86 to '98. What happened to '98 12 years later? Beginning of Y2K and all the tech crash. Now let's go from '98 12 years forward. Anything happened in 2010? This tiger is pretty damn right, and I'm really concerned about these extremes. So I'm going to depress the heck out of you here for the first 5 or 10 minutes, and then Pat, see my closing slide. Do you think I'll bring him back up? I think I'll bring you around. All right, so what are the extremes that we face this year? Obviously, inflation. How many of you remember LIBOR went away December 31? We have like a few sprinkling of those for the U.S. because we couldn't figure out how to fully transition. The Fed forgot about LIBOR, right? FOMC monetary policy. Look, the Fed has no damn clue what they're doing. I was inside there during the last crisis, and I can tell you every tool that they think they have, raising interest rates or pulling back on the balance sheet, is what? It's more inflationary, right? So they have no clue. COVID variants, we're going to have more. Just get used to it. We're going to get a COVID shot every year, and we'll move on with life, and we'll figure out that Texas and Florida and a lot of the southern states were right. We'll all be fine. Supply chain disruption, I pray to God that next year we never hear this term again, right? That we figure out how to get it done, but guess what? It's going to take 2 or 3 years, and my theory I'll share with you in a minute on how it's going to get cured, and it's incredibly good for Texas and Houston in particular. Midterm congressional elections. All right, get your travel calendars out and be the hell out of the country during the midterm elections next year, because half the country is going to riot. They're not going to be able to accept the consequences of these midterm elections. And if you thought there was rioting last summer, you haven't seen nothing yet that happens. But I do pray, I'm going to reveal a little bit of my politics here. I do pray that we reinstitute capitalism in America next November, right? Can we do that? And if we don't, Pat knows I coined a phrase a few years back called Flexit, and it's where Florida and Texas just exit, and that's our form of the European Brexit. Okay, so we're counting on Flexit from Texas. All right, and then commercial real estate values. This is something I want all of you, we're the bankers in the room. I'm gonna scare the bankers right now. Right, if they have construction loans, and think about where the appraisers are in the room, we're in a point right now where expenses are rising more than rents. And when expenses rise more than rents, what do they do to NOI? It tends to bring it down. And if the Fed raises interest rates, and we don't know it's going to be 4, 7, 8, 0, they don't know what to do, they're going to go on Chinese New Year holiday. But if cap rates go up, expenses outrun revenues, what happens to commercial real estate values? They have to slow down or correct. And I think this is one of the big concerns, really to figure out how this is happening and where and by property type. But we are not going to see the kind of numbers I'm going to share with you again in a minute here. All right, let's jump into this. Do what? The next one? There we go. All right. So you don't think this is a year of extremes. I'm going to prove to you it. And Pat knows this because he's probably picked a few of these up along his career. So last weekend, it was so cold in Florida that iguanas were falling out of the darn trees. What the world is going on here, right? But do you know it's against the law in Florida to pick one up and warm them and help them back to life? Why can't we have that with some of the people in D.C. running the place? If they fall over, don't resuscitate them. All right, so this actually happened. All right, so now I'm really going to get into some commentary. This is my disclaimer slide. You're protected. Chrissy, Pat, all of you are correct. These are all my crazy ideas. And so there we go. All right, this is my economic outlook. This is one of 3 slides I want you to really pay attention to. So this is what I think is going to drive the market all year long. So the first on the left, the Fed and the FOMC. So in the upper left corner there, I put the FOMC meetings for this year. All of you take out your smartphones and put these dates in there. Remember, there's no Fed meeting in February, so when they decided last week to not raise rates, they really screwed up the place, because now it's going to be March, and we're probably going to have 8 to 10% CPI, and that's where you're getting all this talk about a 50 basis point increase. The Fed is absolutely behind. It's a cluster. I'll stop there. Cluster bleep, right? All right, so those are the dates. Down in the lower left are the different Fed districts. And so it's important that you understand which district you're in. So I'm in the 6th district in Atlanta. You're in the 11th district. Can we please bring back Richard Fisher? Can y'all get him to come back one more time? The thing ran really well. Do you know in the audit of the Fed after the 2009 financial crisis, Richard Fisher was the only Fed president and governor to get a perfect score on his financial disclosures and his integrity. The only one. And the Fed's only been audited one time, right? Now what happened, right? So, everything went to Boston. I don't know. There's a problem there. So bring him back. So know which Fed district you're in. Your Houston branch is excellent. You have a great branch here. So don't listen to the Dallas. Go listen to your Houston branch Fed people. All right, so we need to see what's going on. Now, at the bottom there, I have a note. And so the Dallas Fed should be renamed the Energy Fed District. The Atlanta Fed, believe it or not, y'all heard about LA, Long Beach, supply chain? That's all we've heard about? And President Biden's going to fix it by making everybody work 7 days a week? They already were working 7 days a week. Even the union was. The Atlanta Fed has more ports and supply chain than any other district in the country. They go from New Orleans all the way around the Gulf 5, all the way around Florida 13, and they come up into Georgia with Savannah and Brunswick. 20 ports and supply chain. Guess how much research they do on it? You wonder why the Fed can't figure out supply chain? And here's what's important about those 20 ports and districts. They handle more supply chain and 20-foot equivalent containers than 2 LA and Long Beaches. They don't have a clue. The way we're going to fix this thing is the supply chain is going to change over the next 2-3 years from one that's based in the West Coast and moves half of what we consume to the east and into Chicago, and it's going to become more north-south. And you guys are at the epicenter of that with Houston and Freeport. Very important study. So next thing is you hear about CPI in the middle. Y'all heard about that thing? Do you know that the Fed and the BLS just make this stuff up and they change the algorithms? So when I started at the Fed, we used to go to the grocery store and we'd buy the same basket of goods, and that's how we would determine how much things cost. Now they do it all electronic. Chrissy's trying to help them out to automate and be efficient. And so what they did is we'd go to the grocery store and the Fed economists would point out to me, see, Cheerios are still just $2 a box. And I'd say, did you read the rest of the label? it's only 12 ounces now instead of 14 ounces. That's inflation. Sorry, we can't change our algorithm. That'll invalidate our PhD thesis. They make this stuff up, and they can manipulate the CPI. So in 2009 and 10, what was happening to home prices after that? Going down? What is the Fed the most afraid of? Deflation. They should be afraid of inflation, but they're most afraid of deflation. So they said, we got to stop it. So they had a phone call with the BLS, and they said, okay, let's change the weighting of shelter, single-family, multifamily homes, from 40-something% to 23%. Da-da, no deflation. Guess what's been happening the prior 3 years? Home prices going way up. It's 43% of the total weighting, shelter is. What do you think they're going to do sometime this year? They're going to change the weighting of shelter and bring CPI down and say, see, the Fed solved inflation. Now, in a little bit, remember a term here. Remember the term barbecue sauce. I'm going to explain, because I'll call barbecue sauce on this. All right, the other one is black swan events, and there's our supply chain. The trucks are roaming around looking for an empty warehouse because Colliers leased all of it up in America, and there's no empty warehouses for the trucks to go. But I'm really worried about black swan events. Can you imagine what the rest of the world from, say, North Korea, Russia, and China are thinking about our strengths right now? We couldn't properly exit Afghanistan. We left all the weapons and everything in Americans behind, right? They know we're not going to go in and support NATO. NATO's totally divided. Germany just wants their damn natural gas that you guys could have provided if they'd woken up a few years ago, right, when we were energy independent. So you think any of them take seriously that we're going to really deal with Ukraine? That Germany is part of dividing NATO right now. That it's the UK, the Brexit folks, that are going to join the Flexit folks that are going to fix the damn world. Do that for me? All right, so I'm really worried, fires, tornadoes. Remember this little thing called the Colonial Pipeline that originates here? So remember the cyber attack last summer in Russia? So we're sitting there in Atlanta. We couldn't deal with 2 days of no gas. We had people shooting at gas stations. We consumed every bit of it. This is not the greatest generation that we have anymore. And so when you look at any of these things, and it's not just the Colonial Pipeline, it's every single utility grid, including yours, that can be hacked by the Russians or the Chinese. So we better be prepared, because China and Russia are sitting back saying, you mean we didn't have to build up weapons? All we had to do was screw with their supply chain and hack their utilities? I want you, not to scare you, but I want you to get prepared, right? Because at the end, you're gonna understand why prepared is important. All right, this is my most important and complex slide I'm gonna give you. This will explain inflation. This is why I think we're going back to the 1970s. And I've been studying. My dad was a ski resort developer in Colorado, and all I know is I got my license in 1977, 78, and gas went from $0.25 a gallon to over $1, and I couldn't afford to drive my 67 Mustang that I still have today that got 8 miles a gallon. It still gets 8 miles a gallon, all restored. So this looks at the blue line is inflation. You go back to World War II, the gray areas are where we've had really high periods. So I put at the bottom there when the Fed got its 2 mandates. This is very important. The Fed's first mandate came after World War II in 1946. Why that time frame? Where's the veterans or really old people like Pat and me? What was going on in 1946? All our GIs were coming home. We were going back to a peacetime economy, and Congress said, Fed, I don't know what you guys really do. This is before crypto and everything else, but you better make sure everybody gets employed. All these GIs get employed, and we're given a GI Bill, get them employed. So that's where they got their full employment mandate. In 1978, they got this thing called the Humphrey-Hawkins Act. This is why the chairman has to go testify to Congress twice a year. It's in the act. It says every January and July, he has to go tell what's going on with price stability. And so that's when we had our big inflation. And so the Fed doesn't even know this. They don't even know that it's a Humphrey-Hawkins speech anymore. It's been so diluted. So the other thing up at the upper right, this is what's happening that hasn't happened in over 4 decades. So anybody from the 1960s? Nobody wants to admit it except me? Okay. I already admitted I was in 62. The 1960s had runaway deficit spending. In fact, if you go back and look at the headlines from the 1960s, the late 60s, to what we have today, you could swear to God they're the same people writing the reports. What was causing the inflation in the 1960s? Vietnam, funding the Vietnam War. So today, we have runaway deficit spending unlike anything since the 1960s. Reagan, shoot, that was a rounding error, right? Just a few little points. It was nothing. All right, the second thing, 1971, President Nixon, he had a lot of great, he may not have been a crook, but he had a lot of interesting ideas. The first one was, let's take America off the gold standard. We became a fiat currency. There's nothing valuing your dollar. Why do you think we don't even carry money anymore? My son asked me what money looks like. I said, hell, I don't know. I just have these plastic things in my wallet. And so this is given a lot to the rise of Bitcoin and cryptocurrency. Because if I'm trading in the dollar and I need to buy chips in China right now for my cars, well, first thing is Toyota says, no, we have them all. GM, you're going to not be the top automaker anymore. The second thing is they said your dollar's been devaluated 20 to 30% in the last year by the Fed doing all of this excess money supply. So they say your currency is worth 20 to 30% less, pay 20 to 30% more, plus the 50% market premium for just getting chips and not Lay's potato chips. So they use crypto. And I was explaining to Pat, I've got a paper coming out where I look at the seasonality of crypto. So how many wants to know when to buy it and when to sell it? I got the answer. So what happens is corporate America uses crypto and Bitcoin to buy the components that they're going to use for manufacturing. So in the late summer and early fall, corporate America builds up Bitcoin. And where do they put it? Where can you find it? Forex, the foreign exchange in their balance sheet. So when you see Forex going up in Procter & Gamble, General Motors, Ford, they're buying Bitcoin. Why? Because they know the damn dollar is going to be worth 20% less and they need to buy a bunch of stuff next year for manufacturing. So why does it drop after the first of the year? All these companies are deploying, they're diluting, they're releasing like the Fed and money supply. They're diluting it all by they're buying all their components. And it's more accelerated right now because these companies need things like chips and components that Trump gave us a warning sign on with the tariffs. We don't make what we need to use here anymore. And so that's what's happening. So buy it in its rise, look at Forex on these bellwether companies, and then look at it drop and they sell it off, and that's when you get the heck out. And it'll go, next year I think it will hit 80,000 in the late fall, maybe 100, right? I gave 18 coins away when I was buying it under 100. I wish I had those 18 coins back. Best question I used to give a Bitcoin when they were physical coins. So there's the inflation. The third thing is, what do we have in 1973 that you guys know very, very well? We had an oil embargo. That was the energy shock. And energy was so less efficient and consumed so much more of our GDP, it had the same effect as what today? Supply chain shock. So our energy shock today is supply chain shock. And it drove the numbers up through the roof. Then Nixon said, I didn't eavesdrop on this, but I came up with this idea on my own. I have a solution for inflation. And I hate Richard Nixon because he resigned on my damn birthday. And every year, the first thing I have to hear in the morning is, this is the day that Richard Nixon resigned. He ruined my birthday, August 9th. But anyway, so he said, I have a solution. We're going to put price controls. Who remembers price controls? No more inflation. I solved it, right? Just like the Fed's going to try to come up with some magic bullet. So what happened when we lifted price controls with with Ford and Jimmy Carter? It went to heck. What is the equivalent? What is the gimmick that is the equivalent of price controls today? It's the Fed's balance sheet. Anything that won't sell at the price that the Fed wants it to. If they want the 10-year Treasury at 150 to 175 and it's not doing that, they go in and buy it at a premium. If they want mortgage-backed securities to stay calm so people can buy homes, even though they're dealing with double-digit inflation numbers, they go in and buy those. Well, what has the Fed just told us? Well, in March, damn it, we're going to shut down the balance sheet and we're going to quit buying 10 billion, 15 billion every month. And in a year from now, we're going to completely quit buying on the balance sheet. These idiots, they ran up to $9 trillion. $9 trillion. We were below $4 trillion before COVID started. $5 trillion they ran up. And you think you're going to soak that up in 1 or 2 years without disrupting the economy? They're going to blow it up. And they're going to have to come up with a new trick. So the last thing is they had bad data. We didn't have computers. We didn't have Chrissy. They were just making the numbers up. They were changing them. They didn't even have Lotus or Excel. So they were doing this manually. Can you imagine that, Chrissy? Right? Insane. And we have the same thing today. Remember the Fed tells us they're data dependent? And you ask them what data they're looking at. What are they looking at? Very bad government data. BLS revises things. Why don't they look at some of the industry data that I'm going to show you? There are so many signs of where inflation were months and months ago that the Fed could have done something, just like the subprime mortgage crisis. That was the most foreseeable thing, and I advised Bernanke in summer of 2006 and said, this thing's going to blow up. We could have double-digit inflation, the GSEs go under, and I was told I was a little crazy, and I had a timeline in my presentation, and Bernanke said, well, it's an interesting one, and I said, well, would you autograph it for me? So we autographed this presentation that I'll be glad to share, send it to Pat, you can send it out. It says, Casey, interesting presentation, but I want to assure you, none of these things like the failure of the GSEs or any of that stuff could happen in our modern banking system. I didn't miss one thing by 6 months, and I didn't have a PhD. You know? Is that me all right? No, I'm good. All right, so that's why I'm in this camp. We're going back to 1970s inflation, and we all need to prepare. Who still owns bonds? All right, think about it, right? What happens to bonds when inflation really gets out of control? They're worthless. Get the hell out of bonds, right? That's my technical thing. Really think about it and look at where, just call Pat and he'll help you find some real estate here. All right, now I'm going to show you, this is the stuff the Fed should look at. Who of you have heard of ENR, Engineering News Record? Awesome, great audience. So they track all the construction activity, and they have a construction cost index and a building cost. Construction is materials, and building is materials plus labor. Look at the bottom where we were last spring. 4% materials, 6% labor. Look at where we've skyrocketed to since last fall. We're at 8% materials, that's average, and 14% for building and labor. The latest one I read on the plane, you can tell I'm almost 60, be there 60 this year. I still have printed material. I have the electronic too, just for Chrissy. And so they have a separate new report on just steel-related products, rebarb and all that. So Dallas is one of the cities that they look at. It's the only one in Texas that they do as a proxy for Texas. And the average for anything steel or aluminum in the last year over year for here in Dallas and Texas is 72%. Am I about right? Trying to get the steel? Now, you want rebar, right? You want, or building sheet plate? 289% increase. So forget about new construction. How many of you have a tenant to move around this year? And you need metal studs, and you need all that kind of stuff. These are the numbers we're looking at. These are real, and this is anything over $2 million in permit value. This is very real type stuff that the Fed can't figure out, and when you get to residential, it's even worse. I do with the, oh, here we go, so down here. All right, so that one I want you to look at, banks in particular. I know you won't identify yourselves, but you need to be looking at your construction loans right now. Because if you're in midstream or starting a new construction project and you're looking at, the other thing on here is the city index, the average is over 15%. What are the two cities that have the highest average rate of new construction? Atlanta at 25% and Dallas at 21%. So if you're a lender and you have these cost overruns and it comes in 2 years at 20% plus, you have a 40+% cost increase in that construction loan, the cost overrun. Who's going to pay it? The banks are going to say the loan agreement says you got to pay 70%, we'll only do 30%. And what do you as the developer say? You want an empty building? You want an incomplete building? You're going to step up to the plate. But this is where the bust comes in the bank. So the banks are making a lot of net interest margin, and this is where the credit loss comes out of all those net interest margins. All right. Inflation. So how many of you heard of Green Street? So Green Street looks at the institutional assets like you have here in Houston, and they look at what property types had the most increase last year. Anybody do self-storage? Sell. It was the number one, up 66% last year. This doesn't happen. These kind of increases just don't happen. Look at industrial, 41%. So Pat was a little bit worried about industrial, and we're long in the tooth. Look, we're building about 350 million square feet of industrial nationwide right now. We need 500 million square feet a year for the next 3 years, and we won't move the average vacancy rate off 5 or 6%. Industrial people happy? Just build it, just Nike it. Everything we're doing in retail and supply chain, and all where we need the supply chain, we don't need any more in California. We need it here from Texas in the center of the country where the supply chain's moving north to south and it hasn't been built. If you look at the Amazon warehouses, the FedEx warehouses, the Home Depot, they're not building that much in California. It's all in places they haven't built before. So no big problems to deal with there. And then think about the CRE impact and value. Expenses rise faster than rents and cap rates go up because of the other. This is not sustainable. So take your jelly beans off the table. This is a time to harvest. Call Pat and them. They'll help you sell at a great number, and they'll help rotate you. Where's your young broker that does for rent subdivisions? Somebody, well, anyway, there he is right there. Stand up. You call this guy. He's been in it for 2 years. This is the next moneymaker. For rent subdivisions. It solves affordable housing, and it's booming here in Texas. It's a great solution. Is that a good call out for him? All right. Volatility. So if you don't believe what I'm saying, who's heard of the VIX, the Chicago Board of Equities, VIX? This is what to pay attention to. And if you look at the VIX, the green line is the history. We're back above 30. When you get above 30, all hell's breaking loose in the equities market. Look what's been happening in the stock market. Was it yesterday or today where at the midday it was down over 1,000 points? We've had 3 or 4 of those type days in the last week. And what it's saying is the market is anxious. They're upset. And they're getting, it's like an earthquake. There's little tremors. Same with a volcano. And then it erupts or you have the earthquake. This is what the VIX will tell you. And so what's going on at the bottom there is there's fear growing about the Biden administration. And if he'd do something right, I'd give him credit. But I get this cue card out and I'll read, my name is Joe Biden. I'm President of the United States, wherever I'm at. He was in Atlanta doing something for the voting rights bill, and he said he was very glad to be here today in Alabama. Okay? Anyway, they're worried about competency to manage COVID, inflation, and geopolitical risks. Y'all disagree with that? That's what we're anxious about, and that's what's causing the volatility in the market. Follow the VIX, and it'll tell you what the bleep's happening. All right, history of Fed rate hikes. You hear all this stuff? And the Fed says, we're committed to rate hikes. The Philadelphia Fed President Harkin spoke on Bloomberg this morning as I was going to the airport, and he says, the most important thing to know is we're finally committed to raising interest rates. What an idiot. Absolute idiot. Can you please bring back Richard Fisher? Can you guys do that, please? All right. So when the Fed starts rate hikes, on the right is the 10-year trend, and the left is the 20-year trend. They never move less than 8 times once they start. And there's typically a 50 basis point increase. So you can see on the far left, the 20-year, when we went back to the great housing crisis, when breathing into 2004, they moved rates from 1% to over 5 in less than 18 to 24 months. So once they start, it's kind of like being addicted to something. You just can't stop. So this isn't going to be 3 or 4 rate hikes. We're in a cycle where there's probably going to be at least 8 rate hikes, and it's going to be very, very jerky. The next thing is, oops, I went back the other way. Sorry about that. So here's the other one. This is why the Fed can't fix inflation. Remember me talking to you about the record deficit spending? Who's heard of visual capitalist? If you want to be a broker to be really smart and be ready at every cocktail meeting, go look at the latest visual capitalists. They take big data. I think they have Chrissy working a second job there, Pat. And they put it in great graphics like this. So what they've shown is the history of our debt. I had to break this in half over the last 120 years. And what you need to know from every decade, from 1990 to 2000, 2010 to 2020, each decade, we've run up more debt than the 120 years before that. The next decade, the 130 years before that, the 140 years. We're on a trajectory that is unstable as a fiat currency. The Fed can't control that. And it's like a credit score. If you run up debt on all your credit cards, what happens to your credit score? Down. That's what we're doing. And our credit score with China, Asia, the rest of the world, it's going down. And the Fed can't stop that until they get Congress to get the fiscal situation under control. Can we please bring capitalism and whatnot back to America this fall? Please. All right. Who's heard of zombie CRE? I know Pat has. And we have like zombie dances, and all that kind of stuff, and at Halloween. A zombie CRE company or a zombie company is one that's making profits, but not enough to pay its debt. And we have about 5% of our companies in this country right now that are zombie companies. They make just enough but can't hardly service their debt. Banks, you paying attention? C&I lending? So what industry do you think has the most? Commercial real estate. 7.5% of our commercial real estate companies, mortgage companies, brokerage companies, except Colliers, are zombie companies. They can't service their debt. Listen, pay attention to those numbers that Pat went over on how well Colliers is doing, and think about who's not. And when this blows up, how do you think these do under higher interest rates? Not so good. All right. Jobs. Who's interested in jobs? So we got a JOLTS report. So this is one of the ones I follow versus the made-up BLS number on Friday. Just get the ADP number tomorrow. Look at what I tell you about JOLTS right now. Go play golf, go have a good Friday. Ignore the BLS data. It's garbage. And here's why. In the third line down, highlighted in red, the Fed and the BLS no longer know how to measure labor. Because of COVID, we have more people that have gone entrepreneurial, work at home, or subcontractors. My little company that I started a year and a half ago, my 4 employees, according to the BLS, are still at home watching Judge Judy eating chocolates. They don't know how to pick it up. They only survey companies, excuse me, that you get a paycheck from and they do withholding. And everything else they don't know how to count. So when they tell you they can only find 200,000 jobs, or Friday things say they found none, and the ADP says, hey, man, we're finding 800,000 every month. The ADP looks at everything. They look at the state data. They look at business formations like mine. And so ADP is right. The BLS is wrong. And so don't fret about Friday. Again, it's just bad government data. And so you can see that there. The other thing to pay attention in all of these employment reports is how wage inflation is embedding. Wage inflation is the worst kind of inflation because if Pat gives you 10% raise, how happy are you going to be if 6 months or a year later he says, Chrissy, give that back to me? What are you going to say? See you later, right? You can't get rid of it. And that's why the Fed worries so much about it. All right. I want to prove to you how clueless the Fed is on stuff. So this is the Atlanta Fed, and they took a product I built over 5 years and briefed Bernanke and them, and they created this new thing called the CRE Momentum Index. Who's seen it or heard of it? Good, you've been saved. Well, one person did. You probably have heartburn, right? So here's the first thing they did. How many of you in the commercial real estate industry view green and blue in a coding or a report as something that's good, right? Moody's green, yellow, blue, red report, right? Green is good. Well, the Fed's, and then yellow and red is bad. Well, the Fed said you all were idiots. For 75 years of what you've done, green and blue now is bad and downward trending. So look at the Gulf Coast. Look how green and blue. You think the entire Gulf Coast and Texas and Houston are green and blue downward trending after what you just heard Pat tell you? It's insane. The second thing they do is they say, well, what we're doing is we're not going to tell you how we get to these numbers. What we're going to tell you is we're taking CoStar and Moody's data, we're reinterpreting it, and we're coming up with conclusions that are 180 degrees different. So you know what I do when I see that kind of data? I give it a barbecue sauce award. So I grew up in Colorado, 40 years in the South. I've learned that the polite way to call BS on something is say barbecue sauce. And we've even got a co-packer making our own barbecue sauce. So send Pat and Chrissy a request, and we'll send the crates to you, and you can distribute, and we'll charge a distribution fee. You get a new warehouse for it. So the back label says, no calories, cures cancer, and prevents COVID. The French side says, I'm the Red Shoe economist, and I'm just going to call barbecue sauce on that. So anything you have come across your desk that you know is just BS, you can take your bottle out, sprinkle a little barbecue sauce on it, and hand it back and say, come back, right? Nothing like that ever happened to Chrissy's work. So the next thing, Pat mentioned the U-Haul migration report. So my best Christmas present comes in January when the U-Haul United Van Lines reports come out and tell you where everybody moved. Who's seen this? Other than Pat's slide. Guess what? Texas is back #1. And like you said, it could have been even super #1 because they ran out of damn U-Haul trucks. They couldn't get anybody to take a truck from Texas and take it back to California so we could move more people here. Right? So Texas came out #1, Florida #2, and it really is the South. We are moving like after World War II, we're moving inland and south. And that trend is not going to stop because #1, we're affordable. You, Tennessee, Florida, no income taxes, good fiscal, keep your businesses open, put COVID in proper perspective. The rest of the country, not so much. So, and you can see, now Alabama is a strange one. So Pat mentioned, I only did 3 years at Alabama. I went to the University of, Emory University in Atlanta. So I thought the SEC was the Securities and Exchange Commission. And so when I went over to Alabama, I sent the dean an email, and in it I said, well, I better say something about what the university does. So I heard that they did football, but I didn't know about the SEC. So I misspelled Coach Saban's name. And so my penalty, my probationary period, was for 6 months to wear red shoes at everything at the University of Alabama. And I had to learn SEC statistics at Alabama. So when I got done, she said, okay, you can get rid of your red shoes. And I said, no. They're a brand, I've already copyrighted it. And then during COVID, they laid me off because I wasn't a tenured professor, so they got rid of that. And then they found out I brought $3 million into the university to run the real estate center. So I was really happy at the result, the national championship. Any school that goes 40 years without a championship, and by the way, that was when I was at Emory and Herschel Walker was playing. 40 years, you deserve a championship. So I was happy for that. All right, next. The census data came out this year, and it further validates everything in the U-Haul and United Van Lines. So what you see, I put a blue circle there, that there's 2 places where people are moving and where growth can outrun inflation. Utah, number 1, Texas, Florida, and it's the Intermountain region, and it's the South and Texas there. And that's all you need to know. The census data, right? Government puts the damn thing together. All right. Every year, I'm a counselor of real estate, and we put together the top real estate issues. And every year, I try to raise my hand and put energy as a top 10 issue, and all of the ESG, DEI people come out and say, oh, no, that's politically incorrect to talk about energy in a top 10 real estate issue. So I'm going to start with that, and then I'm going to talk about housing and close on logistics real quickly here. So energy, so how many of you look at the EIA, Energy Information Association? They just had their January report. In the red circle there, 2/3 or more of our country runs on petroleum and natural gas. And that isn't going to change before I'm in the grave. And I'll add my natural gas to the equation when I go, right? Look at the bottom of all the other stuff, right? The solar and the wind farm and all that stuff, it's like 10, 12%. And it takes more energy to make a damn windmill and install it than it will produce in its first 2 years of life, and then it usually needs replacement or repair. So guess what the message from Texas should be to the rest of the country? You screw with our energy and it's lights out. We can run companies, we'll have Exxon move here, we'll do everything we need, and it's lights out for you and your EV vehicles. Just park them because they won't run, because we produce all of the energy. All right, here is a good one that shows the energy information and this little thing called the Colonial Pipeline and how it went out. Texas produces more electricity than any other state. In fact, you go through every category. It's first or second in every energy category except for one. It could generate this during hurricanes, but it's hydroelectric, right? You're pretty flat. Just think about that. And what you export up to the East Coast. I mean, all the way to Pennsylvania, all through the southern states, we have no damn energy without your pipeline and everything that you do. And all these people that sit there in D.C. and say, you know, we got to stop all that stuff. Look, there's going to be a transition period of 10 to 20 years, and we're going to need you guys. I want you to remember, I hugged you and said, I love Texas, right? So send some energy to me in Georgia or North Carolina. All right, here's the next one. Where's the broker on affordable for rent subdivision? All right, stand up again. Sorry, we can get 2. Give us all your name. I'm old.
Hey, Humphreys, you're paying for this whole thing.
This is what happens when Pat tours me around the office. I try to remember a few things. So this is going to be one of the affordable housing solutions. Our millennials don't have the credit score. They don't have the down payment. And they don't want to live in the city that much anymore. They want to get out in the suburbs. They want to start their families. So this thing called for rent subdivisions, American Homes for Rent is one of them. Their numbers are phenomenal. This stock is one to own. They have 56,000 for rent homes that they built pretty much over the last 5 years, and they're at 97% plus occupancy. And they're moving rents 10, 20% a year. So this is what's going to happen, keep our millennials mobile. So all of those Exxon people that need to move from Dallas, if they had been in a for-rent house, they could have come here. And look at how strong you guys are in the rest of the country. So for-rent subdivisions, that's your stock tip here. The other thing is multifamily. So Pat indicated a little bit of concern. Here's what I want you to know about multifamily. You have a little higher vacancy rate like we do in Atlanta because we just build too much and never stop. We have, for 100 at the bottom, 148 of our 150 largest MSAs, which include Houston, the overall number, Class A, B, and C, not just the new stuff, we have 96% occupancy. Now, this year we will build and deliver more multifamily units dating back to 1987, 425,000. Guess what? We could deliver 500 or 600 or 700,000 and still not move that needle very much. The millennials can't buy homes. Your broker here can't build new for rent subdivisions quick enough, so we're gonna need multifamily. So any of you multifamily people, breathe. And cap rates, yes, they're going lower. Get ready for 5, 4.5. It's a good market, and you have the energy. So energy costs are lower, so you can charge more rents, where the rest of the country can't. All right, this is industrial. Where's my friend Lisa Bridges and then Chrissy? Where's Lisa? She left. All right, so this is your industrial team. They don't even wait for their bow. So this is the numbers Pat kind of went over. The big part of what you need to know, the Houston market on industrial is great. You can build more and it will come. Here's the big story. We're rebuilding our supply chain. So from West Coast, this spaghetti graph of lines are our Class 1 railroads. And there's a big rail merger that's just about to close. Who knows what it is? Kansas City Southern and Canadian Pacific. And that'll be North America's first Class 1 rail. It's the red line that goes from up there in Canada, comes down to Kansas City, the brown-purple line all the way into Mexico. It connects everything through Texas, everything through the center of the country. We have 5 Class 1 railroads. You have 3 at Port Freeport alone. And remember, the Houston Ship Channel, they don't want containers out there screwing up the place, right? They might get stuck like they did in the Suez Canal, right? So Port Freeport is set up to be to Dallas in all of Texas what Savannah, the Port of Savannah, became to Atlanta in the southeast. It's a big, big deal, an asset that you have. So and I put those at the bottom, but we're remaking our supply chain. And so I just did a paper for a client. We finally got Alabama to realize that inland ports were a good thing. When I was at the University of Alabama, we got them to fund an infrastructure bill to rebuild everything in Alabama. And the first part of their gas tax, which they hadn't raised in 25 years, went to the Port of Mobile. And they took it from a cargo port to a container port that has Airbus and Walmart and everybody else. And by end of 2023, the Port of Mobile will handle more containers than the Port of Charleston. Savannah this year, when the numbers are tallied at the end of this last December, 2021, Savannah will surpass New York as the busiest container port in the entire East Coast. That model that the Atlanta Fed has, and they don't study, from really New Orleans all the way over, and you put Port Freeport and Houston in there, this is our supply chain. It's all our ports. We can take all the stuff that's backed up off LA, we can bring it around within a week through the Panama Canal, up into the Gulf Coast, supply chain America, and just say, bye California. So there's 2 things you can do. So that's one, was your ports. The other one I mentioned a number of years ago. Do you know why Texas will frack and drill and produce oil even if it goes back to $20 a barrel? It's your patriotic duty. You're trying to keep pressure on the San Andreas Fault. So it just goes. All problems solved. I'm solving all your problems for you, right? All right, industrial. Look at the earnings numbers. So here's Prologis, the largest industrial REIT in the country. Third quarter last year, they said we have almost 1 billion square feet and we're full. They just released their earnings this past week, 97.4% occupancy. Rent increases, just like what Pat was saying, up 33%. And the same store sales, the ones that were open a year before in COVID, they were up over 7%. This is where you outrun inflation and why it's going to continue to go. So look at earnings like Prologis. Office. So where's your office people? I know Granite's a good sponsor. So here's the good news to mitigate what Pat said about how awful office is. Right, Pat? This is my favorite resource. It's called the Castle Systems. How many of you have a key card to go in and out of your offices? Everybody in America does. They created it, and part of the licensing deal is they collect all your data. They're worse than Facebook on collecting data. And they tell us who's going back to work. We're not even back to 28% going back to work, but here's the good news. Texas, Austin, Houston, Dallas, you're number 1 in the country at back to work, over 40%. And in December, it was over 50%. So Texas, in addition to being the energy state and the ports and logistics state, you're number 1 in back to work. So any office that's going to recover is going to be probably here in Texas. The other one is distinguish between CBD and suburban office. Real Capitalytics is the only entity that does it, and what they told us about suburban office last year, it went up 15% in value. Companies are looking for pockets of suburban near where their workforce is, and that's probably going to be the new model. I don't think vacancies will completely crater in CBD, but we're going to reprice CBD office. If I can only put people at 1 per 300 square feet versus 1 per 65, I'm going to reprice that rent. And that's probably what's ahead of us. Retail. So look at the REIT data. I want you to take another term away. Who's heard the term, I've coined it, influence density? What it means is pockets in the suburbs, and this is important for housing, it's important for office, is where you have a density of households and they have wealth. They have good incomes, they have good jobs. That retail is just booming. It's what Pat said. Those strip centers, go out to Fort Bend County, go out to Sugar Land, they're booming because you have density of households and you have wealth. That's what to go look for. That's the whole story in retail. No more malls, influence density. All right, my closing slide here. So I was in Las Vegas a week ago speaking to the casino industry and CCIMs, and I walked into, I think it was the Orleans Hotel and Casino out there where we were holding the event, and I had to use the restroom, and I about fell on the damn floor. They had put cup holders, and not one, but 2 cup holders in every urinal. And for the women, listen to this, but none in the women's restroom. Gender bias in the casinos. You guys got to get out there and straighten this out. So I said, that's how you know when you're in Las Vegas, is if you go in the restroom and there's 2 cup holders, you're in Las Vegas. So those are trick gimmicks that everybody's coming up with for COVID, but Texas, these are the impressions I want you to take away with and to scream as loud as you can. And if your congressional and Senate delegations don't get it, bring me back, and I'll bring my blazer and my flashy style. So here it is. Texas is the energy state. It's lights out for the entire United States if we don't have you producing energy and sharing it with the rest of the country. So if the rest of the country acts up, particularly way up where that pipeline is, just turn the valves off, right? Y'all know how to do that, right? Did I say that, Pat? All right, number 2, you're the most back to work state. So anybody that has office investments is granted here. So anybody that has Texas office assets, you're the most back to work. It was up almost to 50% at the end of the year. The last one, you're back number 1 in people moving. If we can get more U-Haul trucks. So if you're going on vacation this year, drive. Take a U-Haul back to California. More people will come here. You don't want to lose that ranking. And the last thing is Texas does ports, logistics, and supply chain. You're the anchoring point in the Gulf for how we're going to rebuild the supply chain. Do not overlook the importance of Port Freeport. Anybody from the port here or Rosenberg or whatnot? So believe it or not, that's my story. There's my company and what I do. I've worn my red shoes, got this blazer just for Pat. And I don't know if we have time for questions, but I'm going to hang around. I'm a 3-part economist, and 1 part is I'm 1 part David Allen Coe. I'll hang around just as long as you let me. So, what do you want to do, Pat? Questions, drinks? That's it.
Thank you, everyone. After that, the bar is open, so enjoy. Thank you all for coming. Happy New Year.